According to the New York Fed, the share of Americans who are concerned about unemployment risk is at the highest level since the pandemic. Nearly half of people surveyed expect unemployment to be higher a year from now. Here with some of the tips for those workers, we've got Yahoo Finance's own Kerry Hannon. Kerry, what are some ways to shore up your emergency fund for uncertainty?
Yeah, that's right, Brad. I mean, this is a perfect time if you're worried about your job, but you still have an income steady coming in at the moment. This is your time to get financially fit, and you really need to turbocharge that emergency fund. It's important to take a look at it, and the easiest way to do it is to really make a habit out of saving, because if you have cash on hand, it's going to make you feel a little more comfortable dealing with any upheavals. So if you can automate this habit of saving from your checking account to a high yield savings account, when you don't even see the money go out, it is the best way to get started. It creates that habit and start that now. Ideally, you want to have a year's worth of living expenses set aside if you were going to face a job loss, but start at 4 months. That's a big daunting number. So start small and let it build up. This is important to do. Also, I think this is a great time while you're building up that savings account, is to start looking at, how am I spending my money? Are there places, if you start tracking your saving each month or your spending each month, you have a sense of where you can get lean and mean. And this will really help you get financially fit to prepare for any sort of rough road ahead.
Are there any ways that your employer can help you save?
Yeah, interestingly enough, Brad, what's happening is many retirement plans will allow you to withdraw money from your 401k plan or employer-provided plan up to, say, $1,000, I think it is. And if you agree to pay it back and do pay it back within a certain period of time, you don't pay tax on that or the penalty. So that can be a good Band-Aid for many people. The second thing is employers are also starting to implement a way that you can automatically save in an emergency fund like you do your retirement account from your paycheck. So they'll automatically put it into an emergency savings account for you. Up to maybe $2,500 is what the number I've heard is. Now, many plans haven't started doing this, but we do expect there's lots of little niggles they have to work out, but we should see more of this rolling out this year.
Now, shifting gears while we have you, now the tax season is over, you may want to consider making a Roth conversion. Why is that something that taxpayers should consider, Kerry?
Yeah, Brad, this is really getting a lot of buzz right now. Should I or shouldn't I convert? Just to quickly remind people what this means is you're taking your money from a tax-deferred traditional IRA account or employer retirement plan, and you're moving it over to a Roth IRA, which the money is not, you pay the tax when the money goes into that fund, but you don't pay tax on the gains and when you take it out in retirement. So it can have some great advantages. But the point is, you do have to pay the tax when you take it out of your tax-deferred account. These are the reasons why it's getting attention right now, Brad. Is first, tax rates are at historically low levels right now, and there is a potential for tax rates to increase in 2026. So many people are thinking, well, maybe I should get money out now while my tax rates are still low. The second thing is, when the market drops, people also think, well, this could be a good time to pull that money out, put it in my Roth, and then when the market bounces back down the road, I get a big pop, and I'm not paying tax on that money coming out, on those gains coming out. So it sounds super appealing, but I will say, this with great caveats. You need to talk to a financial advisor and a tax professional about how this works for you, because you do pay tax in the year you take that money out of your traditional tax-deferred plan. And so it's important to, many people I talk to say, if you're interested, you might do it in increments. Do a little bit, a little bit, a little bit, and just see how it flows out. But again, don't try to time the market. That's not really what you should be doing here.